Hey, good morning. It's Mary Ellen McGonigal, and this is the MEM Edge Show. And this is the show where we put you in front of where the action is in the markets. And certainly we are seeing some interesting action today following last week's really difficult period in the broader markets. So let's go ahead and get started, review what we are going to be covering here today. The first item, as always, we are going to take a look at where we are in the current markets. And of course, this is going to be very critical for you as far as planning your investment plan for the upcoming week. So we'll take a look at that. And then also making a case for home building stocks. And these are stocks that last week, as many of you may know, the broader markets suffered terribly with some of the indices down over 4%. But a number of home building stocks actually rallied last week, and they did so on volume. So we're going to take a look at some of those stocks, and I think this is going to be really informative and educational as far as looking at washed out stocks and what to be on the prowl for as far as potential rallies and turnarounds in those stocks. And then the next area we're going to take a look at is taking a look at the history of defensive groups in the broader markets. While we are seeing certainly a rally today and a bounce, you'll get a sense that there is still a need to be on top of and aware of those areas of the market that are viewed as defensive. And we're going to take a quick look at one of the areas there that has gone on to do well even beyond the market's correction reversal. So that will be certainly of importance. And then also, we're going to also look at high dividend stocks that are outside of utility and REITs. And as many of you know, many of the stocks within those two groups do tend to provide you with these higher dividends and higher yields, but there are other areas outside of those groups that you can take a look at and be on top of. So let's go ahead and get started, certainly with the broader market backdrop. And what we are looking at here is a daily chart of the S&P 500. And you can see I've marked it up quite a bit here. And ideally, what I do want to provide you with is insights as to what a downtrend reversal looks like so that you can know when it is safe to wade back into the markets, certainly full force. So what I've pointed out to you here is a recent example of a pullback reversal, and it is similar to what we are going to want to see, certainly with the correction and a reversal. So one of the first items that I've pointed out here above the daily chart of the S&P 500 is looking at the RSI, and you will want to see that RSI turn positive. And by positive, I mean you want this darkened line to trend back above this dashed net neutral or zero. That is going to indicate a positive RSI, and that's a momentum relative strength indicator. And the next indicator that I've put on this chart below the price history is what are called stochastics. And this is also a momentum indicator. And what you want to see with these stochastics, we're taking you back here to the beginning of July, following a June pullback in the broader markets. So we want to see these stochastics also not only trend positively, but trade above this dashed net neutral. So we have two positive technical indicators that are flashing positive signals, but also we do want to see that price of this broader market index trade above these key simple moving averages. So what I've done here is overlaid this green line is a 10-day simple moving average. The red is a 50-day simple moving average, and the blue line is your 200-day simple moving average. And quite simply, these are smoothed out lines that are providing you with historical price information. So the green line is going to be the prior 10 days of price history, red 50, blue 200. So we want to see and need to see these broader indices break back above these simple moving averages. So now we know what to be on the prowl for. Let's take a look at where we are now. We can see that the RSI is trending negatively, but more recently, and certainly with today's action, it is beginning to perk up and head and trend upward. So that is certainly positive. We will want to see it trend above this dashed line, net neutral. Let's go down and take a look at these stochastics. And we can see these stochastics, once they get below this 20, you can see this 20 line here, the stochastics are in what are called an oversold position. And this occurred during that June pullback here. So we need to see these stochastics come back up, certainly above that 20, and then ideally at some point above this 50 net neutral. So we certainly have work to do here on the stochastics. Like, let's take a look at the price relative to those simple moving averages. Today, the S&P is rallying at this time about 1.4%. So that's what we are viewing here. We're looking at a daily chart again, and the price bar is representing today's action. So we certainly have the most work to do on the S&P 500 relative to these simple moving averages. We need to get back up above. Let's take a look here at the November earlier this month. We did get a reversal attempt. The stochastics turned positive, RSI turned positive, and we did have the broader index break back above the 10-day simple moving average, above that 200-day simple moving average. This was a little less than 2 weeks ago. This was the follow-up to that midterm election rally, but we can see that the reversal attempt did fail. So we're back in a period of trying to get our footing back, but this, again, going back historically, is what you will want to be on the lookout for. Now, let's go ahead and take a look at the NASDAQ. Of course, going into last month's October correction in the broader markets, the NASDAQ was certainly the leading industry group. We can see how powerful, how strong. Take a look at the price relative to these simple moving averages. Now, we did go into, of course, last month's correction, but let's take a look at where we are relative to those indicators that we just reviewed with the S&P 500. Above, we have that RSI, that relative strength indicator, and it is still below that dashed net neutral. We are still in negative territory. It's certainly starting to perk up here. Today, the NASDAQ is up about 1.6%, but we can see the stochastics. We talked about the oversold when it's down below this 20, and it is starting again to potentially turn. So also, let's take another quick look at the price relative to these simple moving averages. I'm pointing out that October low because last week the index broke below October's low, and that was very, very concerning. We did close the week above the October low, but we do still, you can see, have quite a bit in the way of work before we can consider the markets as far as being able to put money to work in a fashion that would be not concerning. So we do, again, still have quite a bit to do as far as potentially reversing and coming out of last month's correction. One last index we'll take a look at here. This is the Russell 2000 Small Cap Index. I like to stay on top of the 2000 Small Cap Index simply because small cap stocks do tend to lead the broader market. We can go back to the correction in the certainly Russell as well as the other broader indices going back to the beginning and earlier period of this year. Small cap stocks did lead us out of the correction, that February correction. And we can also note that the small cap stocks led us and started to deteriorate prior to the broader markets. This is September. Small cap stocks did begin to fail a bit here, and that was well before the S&P and the NASDAQ started to break down. So we want to be on the prowl for small cap stocks to begin to turn positive again with an eye toward the rest of the markets following. So what I've pointed out here is the lows in the Russell 2000 at the end of October. And note that last week we did potentially put in a higher low in the Russell 2000. We're certainly the RSI is beginning to trend positively, as are the stochastics coming out of this oversold position. But similar to the other indices, we're still quite early in this potential process, but I would urge you to stay on top of, take a look, looking at the Russell 2000 in your toolbox, so to speak, because we ideally would like to see this index turn a bit more positive so that we can be on the prowl for the rest of the markets to do so as well. So let's go ahead and take a look. I mentioned that we would review the possibility of home building stocks. And actually, one other area that I wanted to go ahead and take a look at before we get into that particular process, this is something that I like to do each week, where we are looking at what is called a candle glance view of the broader markets. And this candle glance view is something that you can access from your initial interface page on stockcharts.com. And what it does is it allows you to take a thumbnail shot view of various indices, and it is generally going to be pre-populated for you. What I've done is gone ahead and put in my own various indices. So we have each of the broader indices are populated here, as well as several of the larger ETF sectors. So we have the broader indices, consumer staples, utilities, technology, financials are XLF, XLK is technology, and then XLY is consumer discretionary. We're also looking at the VIX here, and then gold stocks as well. So what I am hoping to go ahead and show you is where we are in the markets currently, because what I've done also is overlaid an indicator on top of these, the view for these particular charts. And you can go ahead and put in any indicator that you wish. It will apply that to each of these thumbnail shots. And then for my work, I've put in what's called the RSI, that relative strength indicator. I want to see where the relative strength is in the broader markets. And from there, you can sort it in descending order. So what you're looking at here is strength to weakness, looking at the broader markets as well as those sector ETFs. And we can see that the strongest currently, and again, this is going back over the last 2 months, are gold stocks. They're not particularly super strong, but they're certainly holding in, whereas the rest of the markets are falling apart, so to speak. The VIX is down 7% today. It's resting here at about the 20 level, but it's still up here in the forefront. The VIX is a volatility index, better known as the fear index. And anytime this index gets anywhere in that 18 to 20 range, that's going to be telling you that there is still fear, meaning a lot of uncertainty in the broader markets. And then from there, we can see the financial stocks are showing up strong. The financials actually are up about 0.5% today. Last week, we did see financial stocks outperform the broader markets. They were down, but not quite as much as the rest of the markets. We are going to get into some of the stronger areas within financials today, higher yielding areas that are also growth, but then utilities and healthcare consumer staples. So we can see here in the forefront, we are seeing a lot in the way of defensive groups that are outperforming. Again, we are sorting it by that RSI. And then let's take a look. Here's the Russell 2000 index that is outpacing Here we have the Dow Jones Industrial, the S&P 500, NASDAQ, and then from there we get into some of the growthier areas. By that, I mean we have the consumer discretionaries and technologies lagging. So there's certainly been a very, very clear-cut move into defensive areas of the broader markets and less into these growthier areas. But certainly of interest is the fact that these financials are starting to perk up. And I do put out a weekly MEM Edge report. You can go to meminvestmentresearch.com for more information. But I talked about this over the weekend with our weekly report, the fact that financials are beginning to potentially stabilize. This would be good news. Financials have really sat out, certainly the second half of this year. They've lagged significantly. And for the broader markets to really take flight, we will need to see not only stabilization, but an uptick in these financial stocks. There are signs that this area we are seeing consumer and commercial loan growth and so forth, but that's certainly of note. So with that, let's go ahead and take a look. I talked about the concept of home building, and that being an area that we can go ahead and take a look at. So the first view that we are going to take a look at is XHB. This is an ETF for home builders, and we can see really just how poorly home building stocks have done. We're looking at a daily view of this home builder ETF, and we can see this is taking us back to the beginning of this year, and home builders really have had a tough go of it this year. So what I wanted to point out to you is this lagging period here. I'm taking you back to February, March, April, and so forth. We can see that these home building stocks, a lot of, and many of those names dropped relative to the 10-year Treasury. So let's take a quick look at that. This is a view of the 10-year U.S. Treasury yield, and I can show you how you can access it. What you want to do up here next to your sharp chart, you can enter the symbol or a company name. So quite simply, by entering US and then Treasury, it will go ahead and provide you with this US Treasury yield. And you can do this for any stock, any index that you're interested in viewing. So let's take a look at US Treasury yields. And what I did want to point out to you is going back to this period. I'm going to drill down a little bit further so we can get you the dates. So we note that housing stocks really started to deteriorate once Treasury yields got above 2.8%. So on the right side is your scale. So this 2.8%, I'm going to take you back to this period here in April. So this is when these housing stocks did begin to deteriorate. And then another significant period was the break above 3%. That's going to take us to September. And then housing stocks got hit yet again when the yields increased even higher. And of course, these yields are going to impact mortgage rates, which in turn will impact housing stocks. But let's go ahead and drill down and take a look, because these housing stocks, by and large, are in a bear market. Many of these stocks are down over 20%, 23% or more. But there is thinking out there that the sell-off in some of these stocks is a bit overdone. So let's take a look at some of the names. These stocks, a lot of them were up last week quite a bit. But actually, before we get into some of these individual stocks, let's take a look at some of the first item we looked at were yields, which impact mortgages. Let's take a look at some of the positive characteristics that may present a backdrop for some of these stocks to potentially be turning. The first item we're going to look at, and again, I will show you how to look at this, is let's take a look at the cost of lumber. That would certainly be one of the many needs for these housing stocks. So again, very simply, by typing in the word lumber up here, it's going to go ahead and point me toward it's $LUMBER. This is the actual price of lumber. What I wanted to point out to you is that we did see a peak here in May. Lumber costs have really come down very, very significantly. We are seeing a bit of reversal of that downtrend, but overall, this lengthy period of reduced lumber costs are going to be a bit of a tailwind behind some of these housing stocks. And then also we can take a look at some of the housing reports that came out last Thursday. We did see a bounce in existing home sales for October. So that's another positive potential for some of these stocks. So let's go ahead and drill down, and I will provide you with insight as to how you can uncover certainly where are these housing stocks, what are some of the potential examples. So I'm in the initial interface page here at Stock Charts. We are going to go to Sector Summary. And then from here, you will want to go to the Consumer Discretionary sector. And we can then take a look at these housing stocks. So it is under Home Construction is the underlying subgrouping within consumer discretionary. So here we are. These are all of the housing stocks that are listed. Now, what I would tell you from here is to go ahead and sort it by what's called this Scooter, SCTR. This is a technical, primarily technically driven, longer term indicator, super powerful. So by sorting that highest to lowest, the higher the number, the better. So normally in really robust areas of the market, you are going to want to look at those that are in the 90s. But because housing stocks have been so beaten down, your highest Scooter rating is actually 65. So let's go ahead and take a look at this MDC Holdings, one of the better technically sound stocks, but normally not 65 would be a bit too low, but we can go ahead and take a look for purposes of identifying potential turnarounds. So MDC Holdings is a stock that provides a yield of 4.1% yield. Analysts have revised earnings estimates for the stock up for this year. So this is certainly not the healthiest of stock charts. It's not one that I would turn to immediately, but I will point out the fact that the stock is breaking back above these key simple moving averages. Your RSI is trending positively. Down below, I have what is called your MACD, moving average convergence divergence. This did have a positive crossover back at the end of October, black line up through the red, and now more recently we're up above net zero. So we could potentially see a turnaround that could carry MDC higher, but you can see that there is inherent volatility in this particular stock. So let's go ahead and drill down, take a look at another of these home building stocks. This is another one that does provide a yield, 1.4%. And this is another company where estimates have been revised upward for this year, the remainder of this year. What I did want to point out to you, this is very typical of a number of these housing stocks. Take a look at just how low the stock did get. And this is that bear market that I talked about in many of these housing stocks. This reversal bar here, or the beginning certainly of this downtrend reversal, was the day that the company reported earnings. And they did come in with very strong earnings. They did have a very positive earnings surprise. So similar to those indices that we were reviewing, let's take a look at some of the characteristics that you'd want to see to potentially tell you that this downtrend is being reversed. The first here is that price action back up above these simple moving averages. Your 10-day is the green line. Red is the 50-day simple moving average. So we are beginning to see breaks back above these simple moving averages. Your RSI is trending upward. Your MACD had that positive crossover, the black line up through the red, and now up above this net neutral zero. So I would argue that we've certainly had a significant bounce from this low of 15. We are close to almost doubling that, but there is still a bit more room to go as far as the stock's price rallying up at least to this 28 level. That's another 10%. This is your blue 200-day simple moving average. And the importance of looking at this now here is also going to be quite helpful as far as identifying reversals in some of these washed out areas. And I would urge you to take a look at some of the energy stocks. I did so over the weekend. We're not quite there yet as far as this potential reversal, but this certainly is going to be helpful as far as tuning you into what to take a look at. Let's take a look at another stock in the housing space, NVR. And this is another one that it was upon the release of earnings that the stock did potentially reverse this downtrend, up above this green 10-day, 50-day. So we do still have a little more room to go potentially for this stock as far as reversing this downtrend and the stock rallying. So we can look at Toll Brothers is another stock that does have a yield, 1.3%, still a bit earlier in its potential reversal. But again, overall, housing stocks, a lot of them, the estimates have been revised upward for this year, not so much for next year. So this downward trending reversal that may be occurring here in these stocks, there's a lot of debate as far as whether it will carry into next year. So let's go ahead and take a look. I talked about financial stocks and some of the areas there that are rallying and may continue to do so. These are super high yielding. In the beginning, we talked about the broader market still having work to do. While we are seeing a rally today, there's still caution needed, a defensive stance still needed as well. So here is a look at one of the names. This is EFC, Ellington Financial LLC. This stock yields 10.3%. And this gap up here is the report of their most recent earnings. The company came in 10% above estimates, super strong. The stock's holding in here quite well. We can see that the RSI is up here in positive territory, as is your MACD. This is a company that provides financing to smaller and mid-sized companies. Let's take a look at AB. This is AllianceBernstein, and they are an asset management company, financial advisors. This stock does yield 9.6%, and we can see really how healthy this particular stock is. It's in the asset management space. RSI and MACD are both quite positive, and a lot of the reasoning may be because AllianceBernstein has a large portfolio or amount of their monies that are invested in fixed income. So with the uptick in yield, uncertainty in equities, there has been a big inflow into fixed income funds. One other area, because we are running out of time, I'll take you to is STOR. This is Store Capital. This is a REIT, and it does provide a 4.5% yield. This is one of the sole REITs that is in Warren Buffett's portfolio, and it is worth taking a look at. With these REITs, you want to look at FFOs. So it's a very strong company. I will go ahead and leave it at that. And then for those of you, be aware, stay on top of these markets, and happy trading.